All right. Good afternoon, everybody. Happy Monday. My name is Kirsten Riley. I'm the executive director of Naturally San Diego. One more person. It's great to be here today with the RSM team. RSM, we're going to get into unveiling the mysteries of operational accounting for CPG companies. I can tell you firsthand, the team here has worked so hard on this presentation. We had a prep call on Friday. They are so knowledgeable about all things CPG accounting. So if you guys have any questions, pop them into the chat. And then there were some questions that came up ahead of time. We're going to make sure that we address those. So with that, I'm going to pass it off to Jason Podaliccio. He is a senior manager of tax at RSM, and he is also a Naturally San Diego board member.
Thanks, Kirsten. So, hello, everyone. I'm Jason Podaliccio, a tax senior manager at RSM and a Naturally San Diego board member. To provide a little more insight into RSM, we're the leading provider of assurance, tax, and consulting services for middle market companies in the U.S. We have offices in 82 cities across the U.S., 6 cities in Canada, and also have affiliates in over 120 countries, including Mexico. Within the Naturally San Diego organization, I'm on the finance committee, where I assist with reviewing the monthly financial statements and the annual tax filings. We're excited to have this opportunity to bring both organizations together in a collaboration to discuss unveiling the mysteries of operational accounting for CPG companies. That being said, turn it over to today's presenters. Over to you, David.
Thanks very much, Jason. Hi, everyone. I'm very happy to be here today with you. My name is David Cater. I am a director at RSM in the finance consulting practice. I've been with the firm about 6 years, focusing on outsourced accounting and also technical accounting research. I'm a CPA in Massachusetts. Let's see, I have about 10 years of CPG experience with a prior company, large international manufacturer. I also spent about 11 years overseas working in US GAAP, IFRS accounting. Actually, I'll pass it off to my colleagues, Dave McLaughlin.
Yeah. Thanks, David. Yeah, so Dave McLaughlin, I'm also director in our financial consulting practice. And I wear a couple hats, but the main thing I spend my time in is helping companies usually go through first-time audits or other transformative events. So I help both from a accounting diligence perspective, both for potential transactions or debt offerings. I also help a lot of companies get their finance and accounting functions stood up, either pre-transaction or post-close. I'm a former auditor, so I spent the first 9 years of my career on the audit side, and then I moved over to the consulting side, so I could spend a lot more time helping companies. So I really enjoy kind of working side by side with a lot of companies, kind of helping them through those challenges. So nice to meet you all.
Perfect. Good afternoon, everyone. My name is Connor Leckman. I'm an audit manager and CPA that works out of the San Diego office. So I'm local. I work mainly in the CPG space. I've been with the firm for about 7 years now. I started up in Seattle, Tacoma, and transferred down here in early 2020. And I've also been a part of Naturally San Diego for a few years now. I've been to quite a few of their events in the past. Really respect the organization for what it represents and the companies that they promote. And I think it's a fantastic membership, and I'd hopefully get to meet you all in person here at a future event soon. With that, we can kind of move to the agenda. So today we'll be walking through some miscellaneous accounting topics and including audit related topics. It's going to be fairly high level through the presentation just to kind of level set and get everybody on the same playing field. So bear with us. If anyone has more granular or specific questions, you can definitely drop those in the chat and we'll get to those shortly. And hopefully we'll also be able to answer all of your questions today. If there's anything that we can't answer today, but we know that our firm can, we'll get your information and can follow up with you post-call. So David's going to be walking through the introduction to accounting, including journal entries, the general ledger, and trial balance. Dave's going to be going through the different bases of accounting, and I'll be discussing the audit process. We do have some additional content that we'll share if there's time or the Q&A is a little quiet. But for now, I will pass it on over to David to discuss Intro to Accounting.
Thanks, Connor. So just like Connor said, we're going to start very high level just so that everyone is on the same page depending on your experience with accounting. So this is introductory. but we're going to have to go faster because of the time that we have. So if we start on the left side of the slide, those are examples of dual entry accounting. And I think if anyone has used accounting software, at least the ones that I've used, those are all dual accounting. So it shouldn't be entirely new, but as opposed to, let's say, a single entry accounting where, for example, in the first transaction, you record a sale on a cash basis, you wouldn't have the two transactions there, the two line entries, a debit and a credit. You would just record cash from customer A for this product, $500, right? Whereas in a dual entry, you're really recording, in this case, a debit to cash in the account 1,000 and then a credit to revenue. And in the second transaction you see there, that one's a sale on credit to a customer, let's say for 30 days, the invoice is due in 30 days. In that case, you debit an accounts receivable and you credit revenue. And then the third example, 30 days later, you receive that cash from the customer. So you debit cash, credit accounts receivable. And after that, those two last transactions, then you have the cash, you have the revenue booked, and the receivable is now zero. I'll be talking about just like the key principles, but a key principle is that every transaction you record has to be balanced between the debits and the credits. So, what are debits and credits? The word comes from Latin. Debit comes from debitum, which means what is due, and credit comes from creditum, which means something that is owed to others, or like a loan. So if we move to the right side of the slide on the bottom, you see that assets, for instance, right, like a cash or a receivable, the normal balance is going to be a debit. Now, if you debit that account, it will increase the balance. If you credit the account, it will decrease it. Similarly, for liabilities, it's a credit balance account. Normal balance is credit. So to decrease that account, you have to debit that account, and to increase it, you credit it. If we move to the balance sheet, very high level example of a balance sheet, the key principle there again is that the assets have to agree to in total and have to balance with the liabilities and equity. So left side of the balance sheet are the assets, right side of the balance sheet is liabilities and equity. The assets in US GAAP are, you start from the most liquid assets like cash, and then receivables, inventory, and you work your way down to the less liquid assets like fixed assets and other long-term assets. And on the liabilities, similarly, you start with what is going to be paid first, like AP, taxes to the government, payroll for employees, and you work down to what's like in the case of a liquidation, those are going to be next in line to get paid. So, for instance, you might have next subordinated debt, senior debt, then subordinated debt, preferred stock, and then equity. Let's see, so that I think covers it. Again, if you have questions, please put them in the chat. We'll get back to that. Now that we understand, okay, dual entry accounting, the debits and credits, where are these transactions recorded? They're all recorded in the general ledger. So this is an example of a general ledger. And what you have here, right, you see on the left side, the account number, the account name, you have the dates of the transactions. As you move towards the right, you have other data, depending on how you set up your system, where you might have your customer or vendor IDs, and then departments, cost centers, and so forth. And then finally, you have the debits and credits, and then the balance. This is a very important document. Is one that auditors always ask for because it houses all your transactions. And a key principle is also for your books and records to be done properly. You want to record all your transactions, and they should all be recorded in the general ledger. So if you look, I said before, all the transactions have to balance, right? All the journal entries have to balance. So if you look at the first line here on 1/1/23, there was a payment of $1,500, 598. So, and you see that within that account, there's not an offset. That's because right, the debit side is in another account, and you can see down in the accounts payable account, you'll see the offset to that. And so that's how the general ledger sort of works. It's laid out where you start with all your asset accounts, then you move into liabilities and so forth. Now, at the end, this is just an extract of a GL, but if you ran the whole GL, at the bottom, at the end, all the debits and credits will have to, should balance. And the system should prevent you from booking an entry that doesn't balance. So typically, if you're using the software, it will work. Now, one just last point to point out here is like, if you look at cash, again, starting at the top, 312,000. Again, it's a natural debit account balance. So when you credited that 1,500, right, the balance, you see the balance comes down. And then in the next line, the 12,700, that's cash received from a customer. Then you see the balance come up. And so that works the same for all these accounts. And then the ending account there, right? So this one's only run through 1/6, but let's say it was the end of the month. That ending balance of 323,000 will flow into the next statement, which is the trial balance. The trial balance is a key document, and it's used mainly for two things. One is going to help check for mathematical accuracy as well, and also is going to be used to build the main financial statements. So I'll start with a few things just to highlight. You can see in this simplified trial balance, you have the assets in grayed them out there. Liabilities are in green, equities in blue, and then the income statement accounts are in white. And I ran it for a period between January 1st, 2023 to January 31st, 2023. And so what does it mean? It means like the column 1/1/23 is essentially taking the balances from 12/31/22 and then the activity during the month, all those journal entries that you booked during the month in 2023, and then to get to your ending balance. A key thing in the trial balance is that it needs to foot to zero, right? So you can see both columns. The first column, opening balance, even though it has no income statement accounts, there's no activity in the income statement accounts, it still nets to zero. That means all the asset accounts that are debits are offset entirely by the credit accounts, liabilities, and equity. And then also on the right, the last column on the right, January 31st, 2023, it's also when you sum up all those accounts, the debits and the credits, it has to foot to zero. So that's the mathematical accuracy of this. In the column all the way to the right, you see that there's activity in the P&L now, and that activity will, at the end of the year, how you have the system set up, whether it's monthly, quarterly, or annually, those income statement accounts will roll into the balance sheet account retained earnings. So you see there. Then the next thing is, okay, what do we use this for? We use it to create the 4 basic financial statements under US GAAP, IFRS, and that is the balance sheet, income statement, statement of equity, and cash flow statement. You can see there where the bracket shows the balance sheet accounts, and then you format it in the way, each industry is a little bit different. Based on materiality, you might group accounts. The same for the income statement, you pick up the income statement accounts below. The statement of equity, you pick up the equity statement, and then you show the activity, so the roll forward. And the cash flow statement, it's more involved, but that one is, we typically use the indirect method, which means you start with your income statement and then the changes in the balance sheet for the period. So let's say you run a cash flow statement for the month of January, you would take what was the net income that you had, but that's under the accrual method. So net income doesn't equal cash. So then you look at the balance sheet, all the movements in the balance sheet accounts, and that helps you reconcile to what your ending cash is. So you can show how much your cash went up, let's say 100,000, how much was operations, how much was investment activities, how much was financing activities. Let's see what else. A couple other points. Yeah. A chart of accounts is very important in the introductory discussion. So if you think of this trial balance, but you imagine like the last four columns are not there with the numbers. You just have the account number and the account names. Those are, that's basically a chart of accounts. And it's, it's best practice to have very strong controls around the chart of accounts when you create an account, when you delete it, just so that you can keep control over the accounting records and that transactions don't get booked either on purpose to incorrect accounts or try to hide something, or by in this, by an error. Let's see. I think that's it, but I have one fun fact. I think I skipped it, but in terms of dual accounting, I'm not sure if anyone knew or has heard of Luca Pacioli, but he was a mathematician back in around circa 1447 in the Republic of Florence, which is today Italy. And he is credited today, through history, with being the father of accounting and bookkeeping, and was the first person to publish work on the dual entry accounting system. So I think I've reached the end of my slides, so I'll pass it over to Dave.
Sure, thanks, David. So that was kind of, again, a foundation in the accounting basics, just kind of thinking through, kind of call it accounting 101 type things. And so another thing we wanted to talk through in this presentation is really talking about the basis of accounting. So for those you don't know, right, there's multiple ways to report your financials, right? So and the level set, I guess there is no right or wrong when it comes to like how you report. It's really going to be dependent on the users of the financials, stakeholders, so owners, lenders, other key stakeholders as far as what you need to report on. So there's definitely not a right or wrong. That's a question I get a lot. It's like, hey, do we have to do it one way or not? But what I will tell you is that as a general rule of thumb, I'll say that when you think about like this slide right here, kind of going left to right from the non-GAAP to the GAAP, and just to make sure I quick explain GAAP, that would be generally accepted accounting principles. So that would be all your accounting principles that you're required to follow. But as you move from left to right, that usually kind of also a lot of times mirrors the life cycle of a company. Many companies, when they start out in their life cycle, when they're starting up, their early stage, even early stage funding, they will be more on the left side, right? They'll be in that non-GAAP basis. And then over time, as companies mature, they usually move towards a GAAP basis of accounting. And the reason for that, generally, is the bigger you get, the more debt you need, the more stakeholders you have. And as you get to that point, those lenders or new investors are going to require GAAP financials. And the reason why they want those GAAP financials is largely because that allows them to make sure that they're comparable to the other companies that they're looking at. And so I guess to start back on the left side here, there's generally speaking, there's kind of three different non-GAAP bases of accounting. So cash basis, which is essentially just, as you receive cash from customers, you record, revenue in cash. And as you record, pay expenses to employees or vendors or whatever, you record those. That's usually very early stage. A lot of companies, as they start to move into that phase where maybe they have, a review, or maybe they start to take on some level of debt, they might move into more of what a modified cash basis, which is like where you would have an AR subledger, an AP subledger. You'd actually record your AR AP, maybe some accruals, kind of dependent on the needs of the users of those financials. And then the other option here is income tax basis. So again, this is a choice of a lot of early stage companies because a lot of times the main purpose of keeping accounting records is to please the taxing authorities. So keeping your books and records on an income tax basis allows you to basically have your book records mirror your tax records. So quickly kind of hitting the pros and cons. I maybe touched a little bit here, but really from a non-GAAP perspective, the pros of using a cash basis are, one, it's way less complex, right? If you're just doing cash or income tax basis, that's stuff you're probably already doing. It's very easy for a general ledger to do it. You're not worrying about complex accounting standards or any reserves or allowances. you don't have cash, cash to GAAP differences for accruals or tax to GAAP differences, which again makes reconciliations between like tax reporting and book reporting easier. And again, in your earlier stage, that's what makes sense. I think it's easier, it's more cost effective. But then, as I said, the cons of using those non-GAAP is that usually under larger debt agreements, or if you want to have other investors, a lot of times those investors or lenders will want a GAAP basis of accounting to make sure it's comparable to those market comps. I see a couple of questions I'll quick address here. So, but just as a GAAP basis, the one thing that sometimes when people hear they got to move to a GAAP basis that they kind of forget is GAAP basis is not just accruals, right? So a full accrual accounting, you think like you're recording accruals for compensation, for invoices not received, for things like rent or utilities, also recording reserves against bad debt for stuff you might not collect. But the other very complex thing that people a lot of times underestimate is complying with a lot of the key accounting standards. So a good example there is, for anybody who's heard it, is like the new leasing standard, which is ASC 842 for anybody who's interested. That requires that you basically record an asset and liability on your books for all leases that you have. Now that sounds simple in practice, but I can tell you from dealing with a lot of implementations, it is not a simple implementation. And there is there is a lift from both a time and a cost perspective. So when you're thinking about moving to a GAAP basis or full GAAP, there is a lot of time, effort, and cost involved in moving from one to the other. So I'm going to try to get these questions. Sorry if I'm missing them. I think I answered for kind of the accrual benefits drawbacks there. So let me, if anybody has a question on that, please feel free to put in the chat. I also see, yes, definitely holding checks. I mean, I think that, the comment I see about holding checks and stuff like that, that's also an issue, like when you go from a non-GAAP basis to a GAAP basis. I mean, one of the biggest things you kind of sometimes realize when you go from a non-GAAP to a GAAP basis is like processes and controls. Another thing that kind of matters when you move to a GAAP basis is making sure you catch, things that historically you haven't really had to think about because you're on a cash basis, but now on an accrual basis, you really got to be careful about like, hey, do I have checks? Have I received checks that should be in the bank? Or, did I cut a check that I need to record in my ledger? Stuff like that. So there's a lot of times there's a lot of hidden things. And that's why I kind of stress the fact that when you're moving from a non-GAAP to a GAAP, don't underestimate the time and effort it takes to do it. Guess with that, I think I answered the questions in the chat. So I don't, Kirsten, I don't know if there's anything else. Okay.
All good.
Perfect. Then I guess with that, glad to answer any other questions in the Q&A. I'll hand it over to Connor.
Perfect. Okay, so yeah, we talked about the accounting side. So now the other side of it, which would be auditing or assurance. So what is an audit or assurance? Essentially, it's an independent look at a company's accounting records and processes by an independent CPA. It provides credibility to a set of financial statements to give shareholders and others confidence that the accounts are true and fair. I mean, what does that mean? Basically, a company's going to have a set of financial statements. There's going to be individuals who make decisions based on those financial statements. So they usually want an independent third party to come in and give validation to the numbers. Oftentimes, this type of service is compliance-based, which is why companies usually don't love to see our faces, unfortunately. And the normal way that it comes about is a company needing a loan, a line of credit, or some other form of a credit facility from a financial institution. There are instances too, though, where owners or equity investors will require it just because maybe they're a little hands-off. They don't have as much insight into their financials, and so they do want the service provided. And there's different levels to assurance, which is what I'll kind of get into here. So the lowest level that you'll find is a compilation. So compilation is literally just compiling financial information into financial statements. It's a great option for owner managers who need assistance in presenting their company's financial information in the form of statements. And it's really not a big lift. I mean, we could probably come in and do something like this in less than a week. And the ask from the company it's just providing the data. The pros would be it's quick, it's cheap, and it's easy, which I find companies often like. The cons would be that there's literally no assurance provided. We don't issue an opinion on this. It might not conform to GAAP, which is what we were just talking about. We literally just take the information, put it together for you. Don't ask questions, don't poke holes in any of it. So again, it's the lowest level. The next level up is going to be a review. It's a more extensive assurance service, which requires not only compiling the financial information, but also performing inquiries and analytics over the information. This provides limited assurance over the balances, which is usually required on smaller credit facilities. I mean, don't quote me on this. I would say anywhere up to like $10 million is where you'll kind of see, like in lending, is where you'll see the review level. Obviously, if it's at the request of an equity investor, I mean, it's subjective. So yeah, depending on the size of your credit facility, a review engagement sometimes can provide a sufficient level of assurance to satisfy the lender, and it will also give you the insights into the financial information of your company. It's likely a few weeks of work, and again, it's not only providing data, but also responding to quite a few inquiries if I'm being completely transparent. So again, pros provides a limited assurance that will satisfy the requirements of some lenders, and the financials are going to get cleaned up. They will get cleaned up to conform with GAAP, which will make it easier if and when you need to transition to an audit down the road. Cons, it's obviously more expensive, more of a time commitment, and it's not going to satisfy the requirements of all lenders, which gets you to the big one, an audit. It's obviously the most extensive assurance service, which will require not only putting together financial information, also performing inquiries, analytics, walkthroughs, and or tests of a company's internal control processes, and tests of details, which is the examination of source documents. So we're going to be asking for payment support and invoices and contracts and agreements and just a lot of stuff, if I'm being honest. It provides a snapshot of the company's business risks. It highlights ways to improve your record keeping and identifies vulnerabilities related to fraud. If you ever want to put your company up for sale, it's a great insight for potential buyers to let them know that it actually is as it appears, that it's really ready for sale. It provides justification for the price. The audit timeline can be weeks to months. I won't lie, a first-year audit is usually a little bit painful because there's a lot of learning for both the company and the firm, both ways. And then there's sometimes unique transactions, right, that add additional time, business combinations, complex debt or equity transactions as an example. So the pros of an audit, you're going to get the highest level of assurance. It's also going to identify gaps in internal controls, which we can recommend solutions for. And it's going to satisfy the requirements of virtually all lenders of any size of credit facility, even if it's in the hundreds of millions. The cons being it's going to be the most expensive and largest time commitment from the company. And then one small thing that's not listed on here is another service that can be provided, agreed upon procedures. It's exactly like it sounds. We can provide a service where we do specify specific procedures. Examples would be like review of a company's internal control processes, due diligence procedures when buying or selling a business, contract compliance review. I just wanted to throw that out there that there is another thing. There's no opinion related to that. It's literally just agreed upon procedures. So I think with that, we can move to the Q&A slide, which I believe we did have some questions that were out before the meeting started.
Yeah, and Connor, I do. I see, Nate, you left another question related to kind of basis of accounting, and I think the question just to read out loud was that do most companies do something in between cash and full GAAP before they're required? I would say, generally speaking, yes. Most companies that we deal with don't go GAAP and they don't go full GAAP until they kind of have to. And there's a lot of times there's a lot in between. So like a lot of times when we are working with companies that maybe are looking to sell and they're in the diligence process, yeah, there's everything in the gamut from like just truly cash basis all the way up to like quasi GAAP, where they're doing a good amount of accruals and stuff like that, but they're just not necessarily compliant with all the standards. There's no right or wrong, as I said. I will say, that the longer, in my opinion, the longer you wait to make the transition, like, if you're thinking about something, taking on debt or a new owner, this, the longer in advance you make the decision and kind of work towards it, the easier it goes. If you wait till the end when you're kind of forced to, it can be a very hard and painful process to kind of convert. But honestly, I deal with that personally every day. Companies that are looking to go to sale, and we basically have to do a full cash to GAAP conversion. Basically make sure it's well positioned and kind of get properly GAAP stated, so everybody has very strong confidence in the numbers of the diligence process, and we do it all the time. But the tighter the timeline, the more costly and the more headache it can cause. So.
Perfect. Okay, and then I think Kirsten, sorry. I see the questions coming through from before. So I think we just go down the line, and we do have a couple of slides around standard costing. The first question: I work with a CPG manufacturer and would like to better understand how standard cost and production variances work. It seems to me that grouping production variances into a single line hides the detail necessary to make improvements. Is this done to show a pro forma of what the results would have been if everything had gone to plan and the standard costs had been realized? So, I can just briefly talk to this, Dave, if you want, and then we can go to the slides. And then whoever asked the question, if you happen to be on this call, if you need to clarify anything, please feel free to jump in. But high level standard costs are set on a predetermined budget, the expected materials, labor, and overhead, essentially to assemble a product. So you determine what you think your labor rate is or your overhead rate is, and apply that to a product. Obviously, actual costs among these different categories can differ from the expected results, resulting in the production variances that will flush through your P&L through COGS. The note as far as putting them through a single line, I wasn't 100% sure what that meant. I didn't know if that just meant at whatever company this is, that all production variances are going through a single line. There's obviously, you can get a lot more granular with that. You could go by SKU, for example, or you could go, by labor, by material, by overhead, right? So you definitely don't have to go through a single line. That might just be, convenience or efficiency, or maybe system limitations. And then, the point basically production variances is I think it helps with cost control. If you do get granular and you kind of break these things out, you kind of have a better idea of where you're running into the biggest variances, right? Which may lead to certain business decisions, right? If you want to continue a certain line, or if you need to, source from a different vendor, whatever it may be. I think that's kind of the point. But Dave, if you want to run through the slides, go for it.
Yeah, no, so we put a couple of slides in here just because we saw a couple of questions. But Connor, I agree with everything you said there, right? The thing I always like to level set when talking about standard costing, because a lot of times people are very confused on the front side of standard costing, is that standard costing is really an operational method for keeping your accounting. It actually is in itself is not a GAAP basis of accounting, because the standard is essentially what you think that you should be able to buy your materials for, or the direct labor and overhead that you should incur as you produce a product. But your actuals is still what should be on your balance sheet under GAAP accounting. And so a couple things to say, kind of when you think about how you record it, how it records through the system. So one thing is, a lot of systems don't do a great job of helping you have great visibility. So if you're on a QuickBooks, even some of the kind of the middle stage, like a NetSuite or something, you do have to spend some time and effort configuring to get at a SKU level, to get SKU level, or you have to kind of export data and kind of manually understand if you really want to understand the, a SKU level, product level variances. Most of the time when I see kind of earlier stage companies using standard costing, they're kind of just looking at a very high level to say okay, hey, this month, did we have, did we incur more cost or less cost than standard, and then maybe try to dig in and to figure out. The other thing I'll say there, just as a side note, because I talk to a lot of companies about inventory accounting, inventory management systems, is you don't have to use the ledger for this too. A lot of companies want to use standard costing because it is, if you use standard costing, you set it up right, you can very quickly see that whether you're having those kind of favorable or unfavorable variances where your actual cost is either above or below your standard or expected cost. But you don't have to do that in the ledger. There's nothing obviously that requires that. And when you go to report your financial statements, you actually have to go and look at your variances and consider, under a GAAP method, you have to actually look at your variances and consider capitalizing those to the balance sheet to be GAAP compliant. Again, because the idea there is your standard is just your expected cost, but GAAP requires that your balance sheet reflect your actual cost incurred. I guess a couple other things here is just operational considerations is, definitely when you're working through, there's a lot of things in a standard costing method that are going to impact everything. One is like how much time you take to determine the standards. So as Connor said, right, like, you set these standards up based on what you want, but depending on how much time and effort you put into figuring out what you think they should be is really the value in looking at the variances, right? So if you don't have time or don't want to spend the time to kind of figure out standards, I wouldn't recommend using a standard costing system, because then the variances are just always going to be like very large, because your standard cost is just something very high level. And then the other thing is updating standard cost. So obviously, if you start going down a standard cost path, you have to, most companies at least update annually, some quarterly, but you definitely got to make sure you have a process for updating those, because a lot of times what we see, especially when companies will go to, sell or are positioning for additional debt, is they'll set standards like 3 or 4 years ago and never moved them. And then it's that process of kind of unwinding and figuring out, like, more realistically what the standard should be and what the variances mean could be a little bit time consuming.
All right. So I think next one was related to standard costing. Oh, wait, do you want to keep going, Dave? Or?
Yeah, I mean, these are just a couple of slides for everybody to take home. I won't spend a lot of time, but just kind of like the components, just to make sure everybody was on, kind of on board, is when you're setting the standard, the things you should include in your standard cost are, essentially materials, labor, that's either direct or indirect, and overhead that's specifically related to the product cost. Standard cost shouldn't include like any SG&A or any depreciation or rent that's like non-production. So the example I always say there is like, hey, if you have one facility that has production and front office, then you shouldn't be allocating the front office rent or utilities to the standard costs or to the inventory. It should be carved out. So, and I think the last slide here is just kind of a discussion of some of the variances. So as Connor was saying, like, in an ideal world, you can kind of see all the different variances that you have in standard costing. So you'd have your purchase price, which is the difference between your raw material estimated price and actual. And then you'd break up your production into multiple variances, which could be, efficiency, which would be, hey, we're doing a lot better or a lot worse than we thought. Yield, which would be like, hey, we have spoilage or unexpected, issues where we're not yielding as much as we wanted to. And then just other production variances based on like, hey, we estimate a labor rate of $10 per hour, but because of inflation, now we're incurring 12. And so those are kind of like a general like breakout of the types of variances you'd see in a standard costing system. But again, understanding each of these components is really going to be dependent on how your system's set up or the data that you can get out of it. So.
One thing I'd like to add, Dave, to this is when I worked in that CPG company, large company, I agree with everything that's been said. And there was, to the question about, how do we record these variances in different accounts and so forth. We had different, like the cost deviations of cost variances for materials and labor, right, for WIP and so forth. But for the financial statements, right, it's all going to go into cost of goods sold. And like Dave said, you're going to capitalize a piece of it into inventory and so forth, and do the overhead calculations to see how much you capitalize into inventory. But for your management reporting, we used to do a lot of work on that, right? And we used to analyze those yield differences like you see there on screen to see where's the wastage, right? What's happening and how can we correct that? So that's more like from an internal operations point of view. But from a financial reporting point of view, the key is, like they said, making sure the standards are as close to actual as possible so that it's GAAP compliant. And then you know, the cost, all these different elements of cost are going to be recorded in the cost of goods sold account.
Yep.
In the P&L.
I think we kind of covered the next question. So I'm interested to understand how production variances for standard costs are accounted for and presented in the financial statements, as well as what the standard covenant ratios used by banks for loans are. The only other quick thing I was going to mention about the production variances versus standard that David, you kind of mentioned too. One thing that we do catch a lot on the audit side is companies do flush properly the variances through their P&L, and they're sitting down in COGS, which is correct. One consideration companies don't think about is, well, what's still setting up an inventory? Because that would still be your standard costing. So you would have to consider, okay, what variance might be setting up my inventory that I need to actually pull up out of my P&L to back up onto the balance sheet. One of those fun things that companies love to hear auditors bash them for, right?
Right.
And then I think, David, you were going to briefly touch on the covenants, the normal ones you see.
Sure. So in terms of loan covenants, in what I've seen the most by far there's a few sections, but the first are liquidity ratios, and those are the current ratio, the quick ratio, and the day sales outstanding. So current ratio is basically your current assets divided by current liabilities. And that's just to see how, can you cover your current liabilities with your current assets? And usually the ratio, it's all subjective, right? Depends who the lender is, your business, the life cycle of your business, the industry. But just say generally 1.5 to 3 is very good, right? Because it shows that you can cover your current liabilities. The quick ratio is slightly different. It's essentially cash, marketable securities, which are marketable securities in this sense means like money market, right? Very liquid, and accounts receivable. So add those and divide by current liabilities. And that ratio should be greater than 1. So it's a little bit, tougher to get that ratio above 1, but that's one that they look at. And also over time, right? They look at your ratios over time to see if, how the business is running. Day sales outstanding, probably done that, right? You take your average AR for the period and divide it by revenue per day. And the goal is to be somewhere, depends on your terms, right? But in the US, typically you want to be under 40 days. From what I understand, again, it's very industry specific. You might issue credit for longer, but typically 30 to 40 days might be, a good DSO. Then the next one is debt to equity, right? Again, coming back to the balance sheet. So you take debt divided by equity is used to evaluate your company's financial leverage. So generally, again, 1 to 1.5, debt to equity is conservative, it's good, but right, it really depends on the industry and life cycle of the company. The next one is debt to total capitalization. So that one is you take your debt and divide by debt plus equity. And this is looking at solvency and to see how much debt you have as a proportion of your total capital. Right? So how much debt is as a result of the total right side of the balance sheet. Those two they'll look at. And then last one is net debt divided by EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization. Right, for emerging companies, startups, and so forth, and even large companies, EBITDA is huge, right? It's used to generate your valuation for your company. And also lenders are looking at that because it's focusing really more on cash, right? It's taking out the depreciation, amortization, and interest depends how you leverage, right? Some companies have a lot of leverage, some companies don't, so you take that out too. And tax is like, it is what it is. Everyone has to pay it. So by focusing on EBITDA, it's closer to cash flows. So what it's looking at is in this calculation, which is very important, is how many years will it take for you to pay back the debt? And depending on, right, the maturity of the business and so forth, they might have some benchmarks, whether they say, well, 3 years or less than 3 years might be good, or 5 or 6 might be better for a more mature company. Those are the ones that I've seen, occur over and over again. And yeah, I mean, there's others, right? I mean, there's many others. There's that are not so much financing, but still they look at your business. They could look at return on invested capital, return on assets, asset turnover, and so forth. But in terms of lending and financing, those are the main ones that I see.
Yep. Yeah, and the most important covenant of all is the audit due date. So don't forget that one. That one's always in there too.
Yeah.
Okay. I think the next one here is business to business accounting once in multiple retailers, best way to keep track of it all. I did want to follow up. I wasn't sure if whoever asked this is on the call. This kind of sound like you potentially have consigned inventory at retailers. So I was looking to try and get some clarification there, but I guess just, off the cusp, I would say, I mean, a sophisticated ERP system most likely is the best way for tracking everything. I mean, especially as you're growing and scaling. That's my advice, but I mean, Dave or David, if you guys had any other input as well.
Yeah, I was thinking similarly, and also if there was some clarification on, just to make sure we addressed the question in terms of, is the concern complexity, let's say, about having your product in different companies and dealing with inventory and sales and so forth, right? As you sell your product to different channels, is that, if somebody's out there with this question, then because that would help as well.
Yeah, and I guess just if the person's on, I think as you are putting your product in multiple retailers, I mean, there's definitely a lot of things to consider. And I think Connor hit on one of the key things is like a lot of larger retailers are pushing companies to be more on a consignment. Obviously the idea is they don't want to pay for the inventory until it moves. And so there are a lot of complexities around that. I mean, you've seen a shift I mean, it's been happening, but you've seen an even bigger shift towards that model, especially if you're in bigger box, the big box retailers. So you do want to make sure you have some process in there to kind of get comfortable with it. But honestly, a lot of times, the big box retailers will have a great, system in order to kind of track what they've used and not used. And, you can obviously have a lot of times in those agreements, you have a right to like audit it at any point. So if there's inventory out at their location, that's on consignment, you can check it. You have rights, usually you have rights to go out and kind of double check. So.
Cool. Well, I can move on to the next one. Oh, sorry.
Yeah, I was gonna say I did see one in the notes. If you're gonna read that, Connor.
Yeah. So what are the typical consequences of not meeting your covenants? Do the lenders increase their rates? It would seem counterintuitive. They want to make sure they get their money back. Totally true. And it is very variable. In a worst case situation, which you do not see, I mean, almost ever, is the lender could call the debt. They could say, you have to repay us right now, basically everything. That is, again, not the normal thing that companies or lenders do. A lot of the time they'll work with you, right? Maybe they'll restructure covenants. They want to get like new projected cash flows, understand, kind of what the future holds and everything else. There might be changes in interest rates, but usually it just results in an amendment. Company will usually owe at least some fees for the amendment and some of the rework and everything. Oh, the additional work the bank now has to do to get everything kind of back to square. So that's usually what I see. I mean, David or Dave, I don't know if you guys have seen anything different, but that's kind of the normal course.
Yeah, I mean, I would say a lot of times there might be a default rate built in within the credit agreement. So like, yeah, I mean, to the point of interest rates rising, you might be, some variable rate and then or fixed rate, but a lot of times variable based on some market rate. And then there'll be a defined default rate, which will be higher than that. So if there is some sort of violation, they can increase the rate. I think more operation and practical advice on this question, I'd say is don't communicate this late, just like anything. I think the sooner you can let the lender know, the better. It helps. I mean, one thing to make sure you understand, right? When you have a lender there's a lot of times an individual on the other side who's also responsible for getting your audit report and whatnot and all that, right? And if they don't know, they can't communicate internally that something's going to be missed or something. So there's also a lot of pressure on the person on the lending side. So if you can communicate early and discuss options, things, it's a lot less painful. And it also just, provides the lender a lot more time, or a lot more heads up than just telling them last minute, like, hey, we're not going to meet this. Connor said audit deadline. We see that all the time. And I can tell you that lenders are not happy when they find out 2 days before the audit deadline that they're going to not get their audit versus, hey, they have a couple weeks in advance to understand understand what the roadblocks are, maybe have some input on, practical workaround stuff like that. So.
Perfect. Next one was, will banks generally lend on a percentage of inventory or AR as collateral? And what is the range of percentage they'll lend against the collateral? I mean, again, it depends, but we do see like asset-based lending. And I mean, I think typically what I see is, anywhere from 60 to 80% of the asset base. I mean, but again, it is variable. There's a lot of different things that the banks are going to look at, but that's usually what I see about that.
Yeah, and I would agree with that. I mean, like, it's going to be dependent on what they see as the risk in your assets, right? So you take AR, if you're selling to large retailers and you have no real risk of not collecting on that AR, or there's inventory that always sells through and you never have any problems with like spoilage or you're disposing of stuff, they're going to be like more likely, and the better the picture you can paint, the more they'll lend against, right? But obviously they have to protect themselves from a collateral perspective. So I mean, percentages can be wide ranging, but I mean, yeah, that 60 to 80% is definitely something we see a lot. So.
Cool. So we can leave the questions open. I think that was everything as of now. We did have a couple more slides that we can run through if questions pop up. I think I have a hard one, but I don't know, David, if you guys can hang on for a couple minutes. But Jay, do you want to switch to the later slides? Yeah, but David, you can take over.
Great, thank you. Can't see the whole slides, but okay, so this is, we're switching gears a little bit now and just going to talk about our outsourcing services that we call it finance as a service. And it kind of ties into what we're talking about today, right? If you were thinking about outsourcing your accounting, we have different solutions. The first one on the left there in blue is staff augmentation. And that is, let's say if somebody in your company left and you needed to quickly fill that position temporarily, but while you were looking for a replacement, or maybe somebody was out of office for a period of time, we can come in and fill that role, right? That's the example of staff augmentation. Short term, typically, a resource that will work under your direction and as part of your team. The next one in green, process outsourcing, as you can see on the screen, is let's say you do want to start outsourcing, but you're not sure if you want to do the whole thing outsourcing, but you just want to, let's say, get like outsource AP or accounts payable, the whole process. We can do that too. It might be revenue, right? Your revenue recognition and so forth. Leases, like David was talking about, is complex. Some of these things are complex. Also could be, order to cash, but well, it's part of the revenue thing, but more than just the revenue accounting. It's really the billing the customers, applying cash when the cash comes back, and so forth. And then, which brings us to finance and accounting outsourcing, which is what I focus on, and that's full outsourcing. If you're thinking I'd rather have an outside firm handle this for us, we can do that. We still would work with US management, so we wouldn't perform a management function. For instance, we wouldn't do treasury, like your treasury activity would still be done by you or your CFO or somebody similar. But all the transactions we would record, and we'll make sure that the financial statements were audit ready, as well as if you needed FP&A, that's the last column to the right. If you needed FP&A services, we could also provide that. On the next slide, we have just some information on the systems that we use. This is not all of it, right? But the more common ones for like operating companies and so forth. QuickBooks is not on there, but we do have clients on QuickBooks Online. And then we also have clients that are on QuickBooks Online and then they want to upgrade into something like Sage Intacct. We do a lot of work with Sage Intacct, either reselling it or implementing it for our clients that want outsource accounting. Oracle NetSuite is another ERP system that we use. It's used by typically what I find is technology companies, also manufacturing companies that want a robust production. Right, we were talking about standard costing, very complex versus regular, actual costing. I had a large pharma client move from actual costing to standard costing using Oracle. It was a year's worth of work to get that done. So maybe it's easier when you're smaller, I guess, to implement standard costing. Then you see other systems there, like Tally is what we use for credit card transactions. So all the credit cards flow through there. You could do the coding, so you can say, okay, is it travel and entertainment? Is it some other operating expenses? It also has a workflow, so there's a prepare, approval. Bill is a system that we use for AP. It has a accounts payable workflow process, so that there's a preparer. You could have a second, first approver, second approver, and so forth, and then management finally issues the payment out to the vendors. Blackline is what we use for our month-end close workflow, right? And in there, we do all our reconciliations. We have our tasks, and what it helps with is the audit. Again, when the auditors come in, everything has been documented in terms of the balance sheet in Blackline. We just give them access. They don't bother you with like, give me the bank statements for this many months and give me what's the support and the accruals. Everything is in there. So it's really cool. It's a really good tool. And then the last slide, I guess, on this outsourcing, if we switch the slide, is what are some of the benefits, right, of this? One is we see that we can close the books faster than others, right? Because we're accountants, we're a CPA firm, but also more accurately. And that's some of the feedback that we get. In addition, it's a fractional service, or let's call it, shared service, fractional, versus having a full-time team in-house. And so I think of it as insurance, right? Everyone pitches into insurance. You can get huge coverage, but your premiums are low. I mean, it's not that low. We're not the cheapest. I'll just say that now. But there should be savings versus having a team full in-house when you do fractional services like this one. Also, we take the risk when there's employee turnover. It's not for you to quickly try to find somebody and teach them everything again. We have our processes set up that we can move teams, people into that spot very quickly. I mentioned the accuracy, and it's a flexible platform. So we have startups all the way to very large middle market companies with hundreds of millions of dollars in revenue. And so we can scale, right? We can grow with you as your business grows. And continuous improvement. So we try to remain competitive in the marketplace. So we're using always the newest technologies, trying to automate things as much as possible, so that those savings can be passed on to you, the client. That's all I had for these slides. If there are any questions, please let us know. Is there a question there? What are some of the best practices you would advise early startups to focus on before they scaled? Sorry, what does it say?
Yeah, I was going to say, I saw that question. I know we're about time, but I guess, I would probably have two pieces of advice for anybody who's like cash right now, but like, hey, maybe in the near future I might be GAAP. Like, one is make sure like you're still using your ERP system as it's intended to be. And what I mean by that is a lot of times, like people will do cash and they'll not record things timely. They'll not necessarily put all the information in the system. And when you're doing a cash to GAAP, kind of conversion, like data is king, right? Is well, I'd say from my experience is if we can get data, like if say you want to convert 2023 from cash to GAAP, if we can get all the data we need, we can do it very efficiently. But a lot of times, more often than not, what happens is like, we try to get stuff out of the ledger, as David went through, and there's not actually information in there. And then we have to try to go to other external sites, like sources, like, you have to go to like directly to the payroll provider to get information instead of like pulling it from the ledger. Or, you have, invoices where you actually have to go back and like request things from vendors because they weren't actually being put into the system. So if you use the system and you have the data, it's a lot easier to convert from cash to GAAP. The other thing I'd say is, anything you do to take baby steps. So, like pure cash is just like, hey, just cash received, cash paid. That modified cash basis, obviously, if you're doing a lot of the major accruals, you're keeping records of AR and AP, then a lot of times the cut down from conversion from like, to full GAAP could be a little bit less. So those are kind of two things. I don't know if anybody else has any thoughts, David, if you have any other thoughts, but those are two things I'd say just like real time you can start thinking about and implementing. So
Yeah, those are great points. And just tying to that is the record keeping, right? So like, for instance, if you're not on a modified cash basis and you have fixed assets, if you're manufacturing, you have a lot of equipment, you're just kind of like just charging it off to expense, right? It's important to have like those invoices like well kept, because when you're going to convert, we'll need to get those invoices, right? Put those assets on the balance sheet, depreciate them over a period of time, and it would just make that whole conversion easier because at that point you're not like just trying to find where all the stuff is. But yeah, I think those are really good. Get the transactions in the system, have a good record keeping for for all of it, and yeah, and then even like I was gonna say earlier that the way I look at it, cash tax versus accounting or versus accrual accounting is the accrual accounting is going to give you the economics, right? It's going to view the economics more than just the cash because there could be lags and so forth. And that's when you're going to sell a business, they're going to want GAAP, they're going to want accrual accounting. Also the banks, as Dave said. And but in the meantime, right, well, while there's not a need for that, you can just stick with the tax accounting cash and but know that as that's going to be coming down the pike, the conversion. Yeah.
All right. Well, thank you guys. We are out of time. I do not run a CPG business. I run a nonprofit, and I still learned a ton of valuable information. I was, what is it, DMing Jason, like, do we do this? What is it? So thank you. Thank you guys for attending. Thank you, RSM, for all of that information. It was great. I think that's it. I mean, I guess I would say if we have any last questions, feel free to chime in. You can just take yourself off mute. Other than that, we will close it.
Thank you, Kirsten, for setting this up for us too.
All right.
Thank you, guys. Appreciate it.
Thanks, Jason. Thanks, everyone. Bye-bye.
Okay. See you guys soon. Bye.
Bye.